The Endgame Playbook: how this war actually ends, who wins big, and why the biggest market move is still ahead. Welcome to Profit Pulse. Let me start today with a question that almost nobody in financial media is asking. Not because it is a difficult question, but because it requires stepping back from the daily noise of missiles and oil prices and political statements, and looking at this conflict from a completely different elevation. A 30,000-foot elevation. The elevation of the strategist who has studied not just this war, but every war that preceded it. Who has watched not just this oil shock, but every oil shock in the post-war era. Who understands not just what markets are doing today, but what they always do when conflicts of this type approach their resolution. The question is simple: how does this end? Not when, not whether, how. What is the actual mechanism through which a conflict of this scale and complexity reaches its conclusion? What are the specific signals that precede that conclusion? Who are the real winners when the smoke clears? And most importantly, for every investor and every ordinary person listening to this, what is the sequence of market events that follows the ending? And how do you position yourself to capture the largest possible share of the relief rally that every major conflict resolution in modern history has produced? Those are the questions this episode answers, not with speculation, with the analytical framework of a strategist who has studied how modern conflicts actually end, supported by the specific data points and sources that define the current situation, and connected directly to the investment decisions that the analysis supports. This is the episode where we stop reacting to the war and start predicting how it resolves. Let us begin. Section 1. Why everyone is watching the wrong thing. 3 weeks into this conflict, the overwhelming majority of media coverage, financial, geopolitical, and general news, is focused on a specific category of events. Missile strikes, leadership assassinations, tanker counts, oil price daily closes, drone interceptions, ground operation rumors. These are the events that generate clicks and views and attention because they are dramatic, visible, and emotionally immediate. But there is a specific kind of sophisticated analyst, the kind who has been right about geopolitical events in advance rather than explaining them after the fact, who has almost stopped watching the missile counts entirely. Not because the missiles do not matter. They do. But because the missiles are not where the resolution of this conflict is being determined. The resolution is being determined somewhere quieter and more consequential. In the conversations between Qatari diplomats and Iranian officials that never appear in a press release. In the Goldman Sachs research note that says higher prices could last through 2027, because Goldman's analysts have done the supply math and concluded that neither military action nor strategic reserve releases can close the 8–10 million barrel per day deficit that the Hormuz closure has created. In the Trump Truth Social post that simultaneously says winding down and deploys 2,500 more Marines. In the Iranian foreign minister's interview with Kyodo News that establishes selective Hormuz access as a diplomatic framework rather than a military one. The sophisticated analyst is watching these quieter signals because they are the signals that precede resolution, not just escalation. Here is the core insight that distinguishes the strategic analyst from the daily news consumer. Wars do not end when one side is militarily destroyed. They end when both sides calculate that the cost of continuing exceeds the benefit of whatever they can realistically achieve by fighting longer. That cost-benefit calculation changes continuously as the conflict evolves. And the signals that the calculation is shifting, that both sides are beginning to prefer an exit to continuation, are specific, observable, and predictable based on historical precedent. In this episode, we are going to identify those signals, map the historical patterns that tell us what comes next, trace the economic and market consequences of the end game, and give you the most specific and most actionable investor framework available for positioning in advance of the resolution that is coming, even if nobody can say precisely when. Section 2. The 3 stages of every modern war and exactly where we are right now. The history of modern conflict, specifically the history of conflicts involving major powers with industrial economies extensive logistics, and democratic or semi-democratic political systems accountable to domestic public opinion, reveals a remarkably consistent three-stage pattern. Understanding this pattern and identifying which stage the current conflict is in is the foundation of the end-game analysis. The first stage is what military historians, drawing on the framework developed by air power theorist John Warden and documented extensively in academic literature, including the National War College's Journal of Strategic Studies, call the strategic paralysis phase. This is the opening phase, the phase of maximum shock, maximum destruction, maximum psychological impact. The United States and Israel's strikes on Operation Lion's Roar on February 28th were the operational expression of this stage. The targeting of Iranian command and control, nuclear infrastructure, leadership structures, and military bases in the opening days was designed to achieve what Warden called systems collapse, the rapid degradation of the adversary's ability to function as a coherent military organization. The opening strikes were operationally successful in many dimensions. They killed several senior Iranian officials, including the former supreme leader, Ali Larijani, the intelligence minister, and multiple Revolutionary Guard commanders. They damaged nuclear facilities, missile production sites, and military bases. They produced the psychological shock that the stage demands. But here is the specific limitation of the shock and awe stage that military historians consistently document, and that is directly relevant to the current conflict. The stage is designed to work against an adversary whose will to resist is dependent on its perceived military invulnerability. When that perception is shattered by overwhelming initial strikes, resistance collapses. This worked against the Iraqi Republican Guard in 1991. It worked against the Taliban government in 2001. Both of those adversaries had brittle political structures where military defeat translated quickly into political collapse. Iran is a different type of adversary. Its political structure, the Islamic Republic, the Revolutionary Guard, the clerical establishment, has been preparing for exactly this kind of military confrontation for decades. Its population has been conditioned by 4 to 5 years of revolutionary ideology to interpret external military attack as evidence that the regime's warnings about Western aggression were correct. The new supreme leader Mujtaba Khamenei's Noura's message, calling the American campaign a gross miscalculation and praising Iranian steadfastness, is not propaganda detached from reality. It reflects a genuine political dynamic in which military strikes have reinforced rather than weakened the regime's domestic political position. The second stage is the economic pressure phase. This is where we are now, 22 days in. The initial shock has been delivered. The military campaign continues but has shifted from maximum intensity shock towards sustained degradation. And the primary instrument of pressure has shifted from military strikes to the economic consequences of the conflict, specifically the Hormuz disruption, the energy supply shock, the inflation transmission, and the fiscal cost of the military campaign itself. This second stage is where the political will of both sides is most severely tested. For the United States, it is tested by the domestic economic consequences, gas prices, inflation, stock market volatility, and the fiscal cost of $1 billion per day in military spending that the American taxpayer is funding. For Iran, it is tested by the domestic economic consequences of a devastated economy, infrastructure damage, isolation from global markets, and the specific suffering of ordinary Iranians who are experiencing the war not as a geopolitical abstraction, but as power cuts, fuel shortages, and the sound of explosions. The critical dynamic of the second stage, documented consistently across the historical literature on modern conflict, is that the side with the longer timeline wins the economic pressure game. The side that can sustain economic pain longer, that has the political structures, the domestic resilience, and the international support to endure elevated costs for more time, gains leverage at the negotiating table when the third stage arrives. The specific historical precedents are instructive. In Vietnam, the North Vietnamese government sustained an economic pressure phase lasting years, absorbing enormous military damage. because the political structure of a single-party state with centralized control and ideological motivation was more resilient to sustained economic pressure than the democratic political system of the United States, where public opinion eventually forced a political exit. In Afghanistan, the Taliban sustained an insurgency against the most powerful military in the world for 20 years, precisely because their political timeline was effectively unlimited relative to the American democratic political cycle that had to justify the war's costs to voters every 2 to 4 years. Iran is not the Taliban. It is a more sophisticated and more economically complex society with more domestic political constraints than a pure authoritarian. But its political structure, a theocracy with Revolutionary Guard enforcement of political compliance, is significantly more insulated from domestic public opinion pressures than the American democratic system. And that asymmetry matters for the timeline of the economic pressure stage. The third stage is the controlled exit, the negotiated settlement, the agreement that allows both sides to claim sufficient achievement of their stated objectives to justify the costs they have incurred. This stage begins not when either side is defeated militarily, but when both sides calculate, approximately simultaneously, that a negotiated exit is better than continued fighting. And that calculation typically happens through backchannel diplomatic channels, through neutral intermediaries, and with a specific set of observable signals that precede the formal announcement by weeks or even months. We have not yet entered the third stage, but we are close enough that the early signals of its approach are visible to those watching carefully enough. Section 3. The Selective Hormuz Framework. Why this is the most sophisticated economic weapon ever deployed through a shipping lane. The Iranian foreign minister's announcement to Japan's Kyodo News, confirmed by Reuters on March 21st, that Iran is prepared to allow Japanese vessels to transit the Strait of Hormuz, establishes a framework that deserves the most careful analytical attention available. Because what Iran has created with its selective Hormuz access policy is not a blockade in the traditional sense. It is something far more strategically sophisticated. It is the first operational example in history of a nation-state using selective access to a critical global commons as a continuous geopolitical negotiating instrument in real time during an active military conflict. Let me explain what I mean with the historical context that makes the novelty clear. Traditional maritime blockades, from the British naval blockade of Napoleonic France to the American naval blockade of Cuba in 1962, are binary. The blockade is either in place or it is not. Vessels are either allowed through or they are not. The blockading power sets conditions, typically surrender or compliance with specific demands, and the blockade is lifted when those conditions are met. Iran's selective access system is not binary. It is a continuous spectrum of access determined by the political alignment of the vessel's flag state with Iran's current political position. Chinese vessels, full access, because China has maintained neutrality and provided diplomatic support. Indian vessels, access, because India has maintained economic relationships with Iran and declined to join American sanctions enforcement. Japanese vessels, access now being negotiated because Japan's government has expressed interest in maintaining oil imports without joining the military coalition. Turkish vessels, access based on Turkey's neutral position. American, British, and Israeli-affiliated vessels, denied. This tiered, continuously updated access system gives Iran several distinct strategic advantages that a traditional blockade does not provide. First, it fragments the international coalition against Iran. Every country that accepts Iran's access framework is, in practice, accepting Iranian authority over the strait. China, India, Japan, Turkey, and Pakistan, together representing billions of people and trillions of dollars of economic activity, are all, in practical terms, conducting foreign policy toward the Hormuz crisis through Tehran rather than through Washington. This fractures the potential international coalition that might otherwise support American diplomatic or military efforts to reopen the strait on Western terms. Second, it gives Iran a continuous diplomatic lever that does not require any single decisive negotiation. Instead of a dramatic binary ceasefire where Iran either keeps the strait closed or opens it completely, the selective access system allows Iran to make small, incremental, carefully calibrated diplomatic gestures, allowing one more country's vessels, opening one more category of cargo, that generate diplomatic credit without surrendering the fundamental leverage. The Wall Street Journal's reporting noted that Iran has been allowing some categories of vessels through when they broadcast specific identifying information as a form of informal permission system. This is not random. It is deliberate management of an instrument of power. Third, it creates a revenue stream for Iran that partially offsets the economic damage of the conflict. Iran is still exporting its own oil, according to multiple reports including AP News documentation that Iranian tankers have been transiting with implicit permission from Iranian naval authorities. According to earlier reporting in this series, Iran exported approximately 1.5 to 2 million barrels per day even during the conflict's most intense phase, primarily to China. The selective access system allows Iran to maintain its own revenue flows while restricting adversary flows. For oil market investors, the selective access framework has a specific and important implication that is not yet fully priced. The selective access system means the Hormuz will not reopen fully until Iran's political demands are addressed in some form of negotiated settlement. There is no military path to full Hormuz reopening that does not involve either the physical destruction of Iran's entire coastal military capability, a multi-month campaign at minimum, or the negotiation of conditions under which Iran voluntarily extends access to all vessels. Every day that this system operates, it becomes more institutionalized, more internationally recognized in practice, and more difficult to reverse through military means alone. Goldman Sachs's 2027 price duration warning reflects this specific assessment embedded in their supply model. Section 4. Follow the money, not the missiles. Who is actually winning this conflict economically? Let me now give you the most analytically useful and most historically grounded framework for understanding who is benefiting from this conflict. Not in a conspiratorial sense, but in the cold economic logic that determines who accumulates wealth during periods of extreme market disruption. The framework comes from a fundamental truth about modern warfare that most news coverage obscures. Wars create extraordinary economic disruption. An extreme economic disruption creates extraordinary wealth concentration, flowing toward the parties positioned on the right side of the disruption and away from those positioned on the wrong side. Understanding which side of which disruption you are on is the core of geopolitical investment analysis. The first and most direct beneficiary category is the energy sector. This requires no complex analysis. Brent crude at $112 to $116 after being at $70 before the conflict began represents a 50 to 60% revenue increase for every barrel of oil produced outside the immediate conflict zone. According to ExxonMobil's own investor relations guidance, filed with the Securities and Exchange Commission, each $10 per barrel increase in oil adds approximately $2.5 billion to its annual free cash flow. At $40 above pre-conflict baseline, ExxonMobil is generating approximately $10 billion more per year in free cash flow than before February 28th. That is $10 billion additional dollars annually flowing to ExxonMobil shareholders, management, and reinvestment programs, value created entirely by the conflict's disruption of supply. The major American integrated oil companies, ExxonMobil, Chevron, ConocoPhillips, the American shale producers in the Permian Basin, and the American LNG exporters including Cheniere Energy are generating extraordinary returns on capital at current energy prices. The Cheniere Energy opportunity specifically, which this series identified weeks ago, has become even more pronounced following the Qatar Ras Laffan force majeure that removed 20% of global LNG supply and elevated spot LNG prices to levels that make Cheniere's export contracts extraordinarily profitable. The second beneficiary category is the defense industry, whose structural investment thesis has been developed in detail across this series. According to the Pentagon's acquisition data and CSIS munitions cost analysis, the conflict has consumed Patriot interceptors, Tomahawk cruise missiles, JDAM guided bomb kits, and a range of other precision munitions at rates that have created massive restocking demand. Raytheon Technologies, which manufactures the Patriot system and multiple other high-demand weapons systems, reported its backlog standing at approximately $190 billion before this conflict began. That backlog is growing. The procurement cycle triggered by demonstrated munitions consumption rates in this conflict, and by every other government on Earth watching those consumption rates and recalculating their own stockpile requirements, is not a short-term phenomenon. The third beneficiary category is the one that most people forget to include in their analysis. Russia. As documented in Part 2 of this series, Russia is a passive economic beneficiary of this conflict in a way that requires no action on its part. Simply the existence of elevated oil prices flowing through the global market, regardless of who is buying or selling the oil, increases Russia's energy revenues by hundreds of millions of dollars per day compared to pre-conflict baselines. According to the Council on Foreign Relations Analysis by Edward Fishman, Trump's easing of sanctions on Russian oil, a measure taken to try to manage American domestic gasoline prices, delivered Moscow approximately $150 million per day in additional revenue with minimal effect on global oil prices. The fourth beneficiary category is more subtle and more long-term: the domestic American energy security infrastructure. The IEA's demand guidance recommending work from home, reduced air travel, and energy efficiency is the institutional endorsement of domestic energy production and energy independence. The political will for solar manufacturing, nuclear power expansion, battery storage, and grid modernization, which was already at historically high levels from previous geopolitical energy shocks, has received a further enormous catalyst from this conflict. The Bloomberg NEF analysis, the Morgan Stanley research note recommending exposure to defense and industrial resilience themes, and the WTO's explicit identification of energy security as the primary threat to global trade. All of these point to a multi-decade investment cycle in domestic energy infrastructure that this conflict has powerfully accelerated. Now the losers. And this is where the analysis becomes most directly relevant to the ordinary person listening. The primary economic losers from this conflict are the categories that this series has consistently identified: airline passengers and airline companies, household consumers facing elevated gasoline and food prices, small businesses whose operating costs have risen and whose customer spending has been compressed, and the developing world economies that are most exposed to oil price volatility without the fiscal buffers that advanced economies provide. But there is a fifth loser category that deserves specific and honest discussion: the American taxpayer funding the military operation. According to the National Priorities Project fact sheet, $1 billion per day at the current burn rate means every American household of 4 is contributing approximately $10 per day, $300 per month, in additional federal debt obligations to fund this operation. This is not a tax that shows up on your pay stub. It is a debt accumulation that will eventually require repayment through either higher future taxes, lower future government services, or currency devaluation, all of which are forms of delayed wealth transfer from taxpayers to the financial interests that hold government debt. The specific numbers, sourced from the Brown University Costs of War Project and the Penn-Wharton budget model, are the foundation of an uncomfortable but analytically important observation. Every major American military conflict since the Korean War has cost substantially more than its initial estimates, and has generated substantially more debt than its architects predicted. The pattern is consistent enough to constitute a historical law rather than a statistical anomaly. The Iran conflict, if it follows the established pattern, will cost multiples of its current estimates. And the people who will pay that cost, not in spectacular explosions, but in the quiet, grinding erosion of public services, infrastructure investment, and fiscal capacity over the decades following the conflict. are the ordinary taxpayers whose political voice generated neither the authorization for the war nor any meaningful input into its conduct. Section 5. The Time Game: Why Iran's Timeline is Longer Than America's Political Cycle, and What That Means for the End Game. This is the section that the most serious geopolitical analysts are focusing on. Not the missile counts, not the oil prices, but the fundamental asymmetry of political timelines between the two primary adversaries in this conflict. The United States is a democratic republic. Its government is accountable to voters through elections every 2 years at minimum. The president faces re-election or legacy concerns on a 4-year cycle. Members of Congress who support the war face constituents at the ballot box in November 2026, approximately 7 months from now. The specific economic consequences of this conflict, the elevated gas prices, the inflation, the stock market volatility, the fiscal cost, translate directly into voter sentiment that translates directly into electoral outcomes. The Yahoo and YouGov polling from March 12 through 16 documented in Part 17 of this series showed that 66% of Americans disapprove of Trump's handling of gas prices. 6 to 7% disapprove of his handling of cost of living, and his economic approval rating is at its historic low of 32%. These numbers are not just public opinion data points. They are the electoral pressure gauge that creates a finite political timeline for the conflict. The November 2026 midterm elections are 7 months away. In American political history, the single most consistent predictor of midterm election outcomes for the incumbent party is economic conditions, specifically the direction and pace of change in consumer financial well-being in the 6 months preceding the election. If gasoline prices remain near $4 per gallon through October 2026, the electoral consequences for Republican congressional candidates who have supported the conflict will be severe. This electoral pressure creates a specific and observable political incentive for the Trump administration to find an exit from the active conflict phase before the summer of 2026, not because of military failure, but because of political deadline arithmetic. Iran's political timeline is fundamentally different. The Islamic Republic is not accountable to voters in the same way. The supreme leader is not elected through open competitive elections. The Revolutionary Guard's institutional interests are not subject to popular veto. The regime's legitimacy derives from its ideological identity as the defender of Islamic revolutionary principles against Western aggression. And a sustained military confrontation with the United States actually reinforces that legitimacy narrative domestically rather than undermining it. This timeline asymmetry is the most important strategic fact about the current conflict that most analysis ignores. It means that the United States faces a harder and shorter political timeline for conflict resolution than Iran does. And it means that Iran's optimal strategy, sustaining enough pressure to create American domestic political problems without provoking the all-out military response that would end the conflict through Iranian military capitulation, is exactly the strategy that Iran is implementing with its selective Hormuz access framework, its drone and missile attrition campaign, and its Nora's steadfastness messaging. The historical precedents for this dynamic are among the most important in modern American foreign policy. Vietnam, as documented by historians including Neil Sheehan, H.R. McMaster and Louis Sorley, ended not when North Vietnam was militarily defeated, but when the domestic American political timeline, shaped by casualties, by economic costs, and by a generation's disillusionment with the conflict's purpose, made continuation politically unsustainable. The January 1973 Paris Peace Accords were not a military settlement, but a political one, negotiated under the pressure of American electoral timelines and domestic economic stress. Afghanistan's 20-year experience offers an even more direct parallel. The American military was never definitively defeated in the field in Afghanistan, but the American political timeline, the accumulated cost of $2+ trillion, the persistent casualty toll, the domestic public opinion that had turned decisively against the war's continuation, created the conditions for the Doha Agreement of 2020, negotiated under a Trump administration that was, in that case as in the current one, operating under electoral incentive to show foreign policy resolution before an election. The specific lesson for the current Iran conflict is not that Iran will win the war in a military sense. It is that the timeline asymmetry gives Iran leverage that goes beyond its military capability. The party with the shorter political deadline eventually negotiates from a position of greater urgency. And the party with the longer timeline, the party that can sustain the standoff longer without facing an electoral or political crisis, extracts more favorable terms from the eventual settlement. For investors, the timeline asymmetry is a specific and actionable analytical input for endgame timing. The American electoral calendar, November 2026 midterms, preceded by the summer campaign season, creates a political incentive structure that makes a conflict resolution attempt before September 2026 significantly more probable than one after it. The window of maximum political pressure for a settlement is roughly late April through August of 2026. That is the window in which the administration's political incentives, the economic costs on ordinary Americans, and the diplomatic backchannels currently operating through Qatar, Oman, and China all converge most powerfully toward a settlement. Goldman Sachs's 2027 price duration warning suggests that the oil market is pricing a longer disruption than the political timeline implies, which means the oil market may currently be overpricing the duration of disruption relative to the political settlement timeline, and which means the resolution rally in oil, the sharp fall in prices when settlement becomes credible, may arrive earlier than the oil market currently expects. Section 6. The 5 endgame signals, what to watch before everyone else sees it. Let me give you the specific observable signals that precede every major geopolitical conflict resolution in modern history. These are not predictions about specific diplomatic events. They are structural signals that consistently appear in the months before a formal settlement, visible in public data if you know what you are looking for. The first signal is oil price stabilization at an elevated level that stops rising. Not oil falling dramatically, that comes later, closer to settlement, but oil stopping its upward climb and establishing a range. This is historically the earliest observable market signal that the conflict is moving toward the third stage, controlled exit, rather than further escalation. When oil stops rising despite continued conflict reporting, the market is beginning to price in some probability of resolution that is not yet visible in diplomatic news flow. According to Reuters, Brent crude has in fact been more range-bound recently than in the first 2 weeks of the conflict, oscillating between approximately $92 at the recent low and $119 at the recent high. This range-bound behavior, while volatile, is structurally different from the relentlessly upward trend of the conflict's opening week. Watch for the range to narrow and stabilize at a level that does not continue making new highs. The second signal is a shift in media tone from war language to negotiation language. This happens before any formal announcement because reporters with diplomatic sources begin receiving different information from their sources. The language changes subtly at first. Diplomatic source cited in the Financial Times who usually discusses military operations starts discussing conditions, frameworks, or timelines for talks. The Bloomberg diplomatic desk runs a story noting that backchannel contacts have intensified. Al Jazeera, which has extraordinary sourcing in both Iran and the Gulf states, begins running stories about the terms that any settlement would need to address rather than about the latest missile strikes. Watch the specific language of diplomatic reporting from the outlets with the best access to intermediary diplomats. Reuters, Bloomberg, Financial Times, Al Jazeera, not for dramatic announcements but for tonal shifts. The third signal is visible activity from the specific intermediary nations that have the relationships to facilitate this particular settlement. For this conflict, those nations are Oman, Qatar, and China, all of which have documented backchannel relationships with Iran and working diplomatic channels with the United States. When the Omani foreign minister visits Tehran and then Washington in the same week, something specific is happening. When the Qatari Prime Minister has a phone call with both Trump and Khamenei within 48 hours, something specific is happening. Watch the travel schedules and the meeting announcements of senior officials from Oman, Qatar, Turkey, and China. These are the organizational signals of active mediation rather than passive diplomatic messaging. The fourth signal is a reduction in the operational tempo of military strikes, specifically a reduction in the frequency and scale of new targeting rather than just a reduction in Iranian responses. When the United States goes from conducting daily large-scale strike packages to conducting occasional precision strikes on specific targets, it is signaling through its operational behavior that the shock and awe phase is transitioning, and that the military tool is being held in reserve to create negotiating pressure rather than being actively deployed to maximize damage. This is a subtle but specific signal visible in Pentagon briefing data, specifically in the ratio of strike announcements per day to the explosive yield and target value of those strikes. The fifth and most powerful signal is a change in political language from both sides simultaneously. Not a dramatic announcement, a subtle shift in the vocabulary that senior officials use. On the American side, watch for language that moves from total destruction of Iran's military capability toward more achievable formulations like sustainable security conditions or Iran's recognition of international norms regarding shipping access. On the Iranian side, watch for language that moves from complete and lasting end of the war toward more conditional formulations about specific conditions that, if met, would support a de-escalation. When both sides simultaneously begin using language that describes achievable conditions rather than absolute outcomes, they are, through their public communications, beginning to set the terms of a negotiated settlement without formally entering negotiations. Trump's own language, winding down, meeting objectives, the Hormuz may open itself, is already an early transition toward the fifth signal's pattern. It is not yet a formal settlement signal, but it is the beginning of narrative management for an exit, which is what the fifth signal specifically describes. Section 7. The backchannel architecture, how the settlement actually gets built. Modern geopolitical settlements do not begin at formal negotiating tables. They begin in hotel rooms in neutral capitals, in encrypted communications between senior officials who will deny the contacts took place if asked, and in the careful testing of whether both sides' minimum conditions are compatible enough to build a framework around. The specific backchannel architecture for the Iran conflict resolution, based on the documented relationships and the public signals from the relevant parties, involves at minimum 3 parallel tracks. The first track runs through Oman. Oman has been the most consistently reliable channel for American-Iranian communication for decades. The preliminary contacts that led to the 2015 Joint Comprehensive Plan of Action nuclear deal were initiated through secret American-Iranian meetings held in Muscat, Oman's capital, beginning in 2012. The Omani government provided the logistical and diplomatic infrastructure for those meetings, including communication security and political cover. Oman's foreign minister has already publicly acknowledged this conflict's diplomatic dimension by stating that the United States needs help to disengage. This is not a neutral observation. It is an offer of services from a government that has successfully facilitated American-Iranian diplomatic contact before. The second track runs through Qatar. Qatar is a more complicated and more powerful intermediary for this specific conflict, because Qatar is also a party to the conflict's economic consequences through the Ras Laffan LNG damage and the Force Majeure Declaration. Qatar has a direct economic interest in conflict resolution and a proven track record as a diplomatic host, most recently for the Taliban-American negotiations that produced the Doha Agreement. The Qatari government is simultaneously managing its own economic crisis from the conflict and its traditional diplomatic mediator role. That combination of personal economic stake and diplomatic capability makes it a uniquely motivated intermediary. The third track runs through China. China's position as the world's largest oil importer. combined with its established economic relationships with Iran and its explicit positioning as a diplomatic alternative to American-owned international institutions, makes it the most powerful potential third-party facilitator available. China has already demonstrated its willingness to mediate complex Middle Eastern diplomatic processes through the 2023 Saudi-Iranian Normalization Agreement, a China-facilitated Iran-America dialogue, conducted through multiple layers of plausible deniability, would be consistent with China's strategic interest in positioning itself as a responsible global actor, while simultaneously reducing the American geopolitical dominance that China's strategic competition seeks to erode. According to Reuters diplomatic sourcing, all three of these tracks appear to be active in some form. The specific progress being made is not visible in public reporting. That is the nature of effective backchannel diplomacy. But the infrastructure exists, the relationships exist, the incentive structures for all parties to use these channels exist. And the specific political timelines, Trump's electoral pressure, Iran's economic exhaustion, China's interest in being the resolution facilitator, Qatar's interest in ending its own LNG crisis, all converge toward active use of these channels over the coming weeks. For investors, the backchannel architecture is important not because it tells you when settlement will occur, but because it tells you that the settlement infrastructure is in place. The plumbing exists. The question is only when enough water pressure builds to start flowing through it. Section 8. The relief rally, why the biggest market move is still ahead and how to be positioned for it. Let me now give you the most practically important section of this episode. Because everything this series has built, the understanding of the conflict's economics, the scenario probability framework, the sector analysis, the historical parallels, the endgame signal monitoring, culminates in this one analytical conclusion. The biggest market move from this conflict has not yet happened. It is not the oil spike from $70 to $119 that has already occurred. It is the resolution rally that will occur when the conflict ends. Here is the mathematics, using data points from this series and from the historical record. Oil entered this conflict at approximately $70 per barrel. It has risen to peak levels of $119, settling in the $112 to $116 range. The current price reflects the physical supply disruption, the selective Hormuz blockade, and the geopolitical risk premium of continued conflict uncertainty. When the conflict resolves, when a credible settlement or ceasefire framework is announced, the geopolitical risk premium component of oil's price dissolves rapidly. Historical analysis from Goldman Sachs's commodity research, and from the Council on Foreign Relations documents that geopolitical risk premium unwinds typically remove $10 to $25 per barrel from oil prices in the first 48 hours of credible de-escalation news, and a further $10 to $20 over the following weeks as the physical supply resumption becomes visible in tanker traffic data. The physical supply restoration will take longer. The Ras Laffan repairs, the Saudi infrastructure restoration, the Hormuz shipping resumption, all of these have engineering timelines measured in weeks to months regardless of when the political settlement is reached. But markets price on expectations of future supply, not just current supply. When the settlement is credible, oil markets will price the expected future supply restoration even before the first repaired tanker sales. The cumulative oil price decline from a credible settlement could be $20 to $40 per barrel from current levels. That is a 17 to 35% reduction in the commodity price that has been driving every major market dislocation of the past 3 weeks. And the market ripple effects of that oil price decline would be felt across every asset class simultaneously. Federal Reserve rate cut expectations would immediately recover. If oil falls from $115 to $80, the inflation calculus changes dramatically. The Goldman Sachs 2027 price duration warning becomes obsolete. The Federal Reserve's policy trap dissolves. Rate cut expectations return to the timeline that existed before February 28th. And equity market valuations, which were compressed by elevated rate expectations, immediately begin recovering. Growth equities, consumer discretionary companies, airlines, European industrial manufacturers, all of the sectors most heavily penalized by this conflict's economic dynamics, would experience relief rallies of significant magnitude. Airlines specifically, which have been pricing the continuation of $100+ oil indefinitely, would see dramatic upside as fuel cost expectations normalize. The defense sector would not sell off dramatically at resolution. The structural procurement supercycle, the decade of elevated defense spending that this conflict has catalyzed across NATO, across Asia, and across the Middle East, does not reverse with a ceasefire. Defense stocks maintain their structural thesis independent of the conflict's military phase, because the procurement decisions being made in defense ministry offices around the world are multi-year commitments that outlast the specific conflict that motivated them. Gold would give back some of its crisis premium at resolution, but the structural gold thesis, the petrodollar erosion, the central bank reserve diversification, the permanently elevated geopolitical risk premium in the post-conflict world, means gold does not fall back to its pre-conflict levels after the settlement. It settles at a structurally higher baseline than it occupied before February 28. The specific investor action for positioning ahead of the resolution rally is the dual portfolio approach that this series has been building toward since Part 1. The core portfolio, energy, defense, gold, short-duration government bonds, is positioned for the conflict's continuation and for the structural changes it has already set in motion. This core holds regardless of when resolution comes, because its thesis is structural rather than conflict-dependent. The opportunistic portfolio, the cash and liquid assets held specifically for deployment at the resolution signal, is the vehicle for capturing the relief rally in the sectors most penalized by the conflict. When the first credible endgame signal appears, when the oil price begins stabilizing and the diplomatic language begins shifting, and the intermediary nation foreign ministers begin crisscrossing between capitals, the opportunistic portfolio deploys into airlines, consumer discretionary, European industrial companies, and the high-quality growth technology stocks whose multiple compression was driven entirely by elevated rate expectations and will reverse rapidly as those expectations normalize. The size and speed of the resolution rally depends on how much the market has already priced in the resolution probability. Today, given that most institutional analysis is focused on conflict continuation scenarios, Goldman Sachs through 2027, IEA 6-month disruption warning, Axios May continuation, the market has relatively little resolution probability priced in. The residual rally when resolution becomes credible is therefore larger than it would be if markets had been gradually pricing it in. The surprise factor, the gap between what markets are pricing and what actually happens, creates the amplitude of the move. Be positioned for the duration of the conflict in the sectors that benefit from it. Be liquid enough to deploy opportunistically when the endgame signals arrive. And have the predefined trigger plan that allows you to act on those signals decisively rather than deliberating while the move is already underway. Section 9. Who actually wins this war? A brutally honest accounting. Let me now give you the most honest and most complete accounting of who the winners and losers of this conflict actually are, not as defined by the political narratives of any side, but by the cold economic and strategic arithmetic of what has actually changed as a result of 3 weeks of conflict. The first category of winners is the energy sector, and specifically the companies and the countries that produce oil and gas outside the conflict zone. This has been the most visible and most discussed economic consequence of the conflict, and it requires no elaboration beyond the reiteration of the specific numbers. ExxonMobil, Chevron, Cheniere Energy, the Permian Basin shale producers, the Norwegian offshore industry, all generating extraordinary windfall profits from a commodity price dislocation caused by a conflict they had no part in creating. Russia specifically, as documented in Part 2 of this series, is receiving approximately $150 million per day in additional energy revenues from the oil price increase, revenues that flow to a government whose strategic interests are not aligned with American success in this conflict. The second category of winners is the American defense industry. The specific winners within defense were identified in Part 13 and confirmed by Morgan Stanley's published research recommendation. Raytheon Technologies, Lockheed Martin, Northrop Grumman, L3Harris Technologies, and the full range of defense technology companies positioned for the decade-long procurement supercycle that this conflict has triggered. The defense industry does not win in the sense of profiting from suffering. It wins in the sense that the government demand for its products has been permanently elevated by this conflict's demonstration of weapons consumption rates and capability requirements. The third category of winners, and the most unexpected, is the cause of global energy transition. The IEA's directive to the world to drive more slowly and work from home. The World Trade Organization's documentation that 1/3 of global fertilizer supply passes through the Strait of Hormuz. The Atlantic Council's warning that Europe is already heading toward an energy crisis, even if a ceasefire is agreed today. All of these are the most powerful possible demonstrations of the cost of oil dependence. Demonstrations that will drive energy transition investment for a decade with a force that no climate conference ever generated. The solar manufacturers, the nuclear developers, the battery storage companies, the grid modernization infrastructure builders. These are the long-term winners of a conflict that has made the economic case for energy independence more visceral and more politically compelling than any theoretical argument could. The losers are numerous, and their losses are severe. The most direct and most visceral losers are the ordinary people across 12 or more countries who have experienced the physical consequences of this conflict. Civilian casualties in Israel, in Iran, in Lebanon, in the UAE, in Kuwait, in Iraq, in Saudi Arabia. No economic analysis that fails to acknowledge this category of loss is honest. The second category of losers is the American and global taxpayer who is funding the conflict without having meaningfully authorized it. According to the National Priorities Project, $1 billion per day in military spending is being added to American federal debt that will compound at interest rates determined by the very inflation that the conflict is generating, creating a doubly painful fiscal legacy. According to the Penn-Wharton budget model's estimate, the total economic impact, including direct military costs and indirect economic damage, reaches up to $210 billion. That cost falls on the American economy through higher gas prices, higher inflation, higher federal debt, and eventually the taxes, service cuts, or currency effects that service that debt. The third category of losers is the developing world. Countries across South Asia, Southeast Asia, Sub-Saharan Africa, and Latin America that are most exposed to oil price volatility, and that have the least fiscal capacity to absorb it, are experiencing economic deterioration that will result in genuine humanitarian consequences. Reduced food security from fertilizer disruption and higher food prices, reduced fiscal capacity for health and education spending, and in the most vulnerable cases, genuine sovereign debt crises. The Indian rupee at a record low of 93 per dollar, documented by Reuters, is the most visible symbol of this developing world stress. But the rupee's movement is just the leading indicator of a broader pattern of emerging market distress that will manifest in economic data over the coming months. Section 10. The view from the other side. Why the world that emerges from this conflict is fundamentally different from the one that entered it. Let me close this episode with the most important long-term analytical observation that the endgame framework supports. The world that emerges from this conflict, whenever the settlement comes, whatever its specific terms, will not be the same world that existed on February 25th of 2026. The conflict has already produced changes that are structural, durable, and consequential in ways that no ceasefire agreement can reverse. The first structural change is Iran's demonstrated gatekeeper status over the world's most important energy choke point. Whatever terms the eventual settlement includes, the world now knows that Iran has both the capability and the political will to selectively control Hormuz access. No international institution, no American naval deployment, and no diplomatic agreement can erase that demonstrated capability. It will remain in every energy security calculation, in every oil market model, and in every government's energy diversification planning for decades. The consequence is a permanently higher baseline geopolitical risk premium in oil market pricing, and a permanently stronger economic case for every energy alternative that reduces Hormuz dependence. The second structural change is the fracturing of the post-Cold War Western alliance consensus. NATO effective non-participation in this conflict, German refusal, French limitation to a purely defensive role, European Union's collective hesitation, has revealed a fracture in Western strategic cohesion that had been partially obscured by the Russia-Ukraine conflict's more geographically immediate threat to European security. The consequence is an acceleration of European strategic autonomy, higher European defense spending, more European diplomatic independence, and a gradual reduction of European security dependence on American extended deterrence commitments, whose reliability has been publicly questioned by the American president calling NATO allies cowards. The third structural change is China's emergence as the preferred alternative mediator for Middle Eastern diplomatic crises. Having facilitated the Saudi-Iranian normalization in 2023, and now positioning as the primary alternative backchannel for this conflict, China has built a diplomatic infrastructure in the Middle East that did not exist a decade ago. The consequence is a gradual but durable shift in Middle Eastern diplomatic alignment away from exclusive American mediation toward a more multipolar diplomatic architecture, in which China competes for influence through economic relationships, infrastructure investment, and conflict resolution services. The fourth structural change is the acceleration of energy transition with national security as its primary political driver. Every government that watched oil prices double in 3 weeks because of events at a single shipping choke point 7,000 miles away has just had its energy security assumptions shattered. The political will for domestic energy production, renewable energy build-out, nuclear power expansion, and energy storage investment has never been stronger and will not weaken when the immediate crisis passes. The consequence is a multi-decade infrastructure investment cycle that will generate extraordinary returns for the companies and the investors positioned in the relevant sectors. The fifth structural change, and perhaps the most profound for the long-term structure of global finance, is the visible demonstration that the petrodollar system's stability can be disrupted by a determined regional power willing to control the waterway through which dollar-denominated oil trade flows. The consequence, as documented in this series and in the academic literature on international monetary arrangements, is a gradual but real acceleration of reserve diversification away from exclusive dollar dependence, increased central bank gold accumulation, and the incremental growth of alternative payment and trade settlement architectures that reduce global dependence on American financial infrastructure. None of these changes were caused solely by this conflict. All of them were already in progress before February 28th, but the conflict has accelerated each of them by years, if not by decades. And the investors who understand these structural changes, who can identify the companies, the sectors, and the assets that benefit from a world reorganizing around energy security, defense investment, multipolar diplomacy, and reserve diversification, are positioned for a decade of extraordinary opportunity that began on the day this war started. Closing, the end game is already being written. The war that appears on your news feed as an endless sequence of explosions and political statements and oil price tickers is, at the strategic level, moving through a predictable sequence that every major modern conflict has followed before it. The shock and awe phase is complete. The economic pressure phase is at its peak. The controlled exit phase is approaching. The backchannels are active. The intermediaries are engaged. The political timelines are creating convergent pressure. And the market move that captures the resolution has not yet happened. The investors who understand this sequence, who have built the analytical framework, who are watching the 5 endgame signals, who have maintained their structural positions and their liquidity reserves, are positioned for the biggest single market move that this conflict will produce. Not the move that has already happened, from $70 to $119 oil. The move that is coming, from 100 plus oil back toward 80 or 90, as the Hormuz reopens and the fear premium dissolves. From compressed equity valuations back toward fair value as the Federal Reserve's policy path clarifies. From the defensive sectors that performed well during the conflict toward the cyclical sectors that will perform best in the recovery. Every war in modern history has ended. Every oil shock has resolved. Every period of maximum geopolitical uncertainty has given way to a new, different, but navigable equilibrium. The investors who were positioned correctly at the resolution, who held their analytical discipline through the noise of the acute phase, and who deployed their liquidity decisively when the endgame signals arrived, generated the most extraordinary returns of any period in their investment lifetimes. Be that investor, watch the signals this episode identified, hold the positions the framework supports, keep the liquidity reserved for the resolution deployment, and maintain the analytical clarity that is the only true edge available in an environment designed to generate fear and confusion. The end game is being written right now in the backchannel conversations that will not appear in your news feed until the settlement is already agreed. Watch for it, be ready for it, and be positioned for the market move that comes with it. This has been Profit Pulse. Stay informed, stay analytical, stay positioned. We will see you in the next episode. The domino collapse. How one war is cracking a global financial system already built on borrowed time. Welcome to Profit Pulse. Let me tell you about a specific kind of failure that engineers call a cascading structural collapse. It does not begin with the biggest component breaking. It begins with a small crack, sometimes invisible to the naked eye, in a load-bearing element that nobody was watching because it had always held before. The crack spreads to an adjacent component. That component transfers its stress load to the next one. That one transfers to the next. And then, at some point that is impossible to predict precisely but entirely predictable in its general character, the structure fails catastrophically, not because any single component was inadequate, but because the accumulated stress from all of the components simultaneously exceeded what the overall system could absorb. The global financial system in March of 2026 is that structure, and the Iran war is the crack that nobody was watching carefully enough. I am going to prove that to you today with specific numbers, sourced rigorously from the world's most credible financial institutions, placed in their precise historical context, and connected directly to what they mean for markets, for economies, and for the decisions that ordinary people and investors need to make right now. Let me start with the most important number you will hear in this entire episode: $109 trillion. That is the current size of the global bond market, combining government debt and corporate debt across all major economies, according to the OECD's Global Debt Report 2026, published just this week. $109 trillion. That is 93% of total world GDP, according to the same OECD report, up from 81% of world GDP in 2015. The global debt market has grown from 81% of the entire world's annual economic output to 93% in less than a decade. And the OECD's own Secretary General Matthias Cormann, presenting the report this week, used words that deserve to be quoted directly. He stated, global debt markets have remained resilient as borrowing has hit record highs, but debt servicing costs are increasing, and unrelated financing needs are growing sharply. Resilient as borrowing has hit record highs. That is the language of an institution that is carefully managing a warning. The resilience is real, but so is the record high borrowing. And the question that this episode answers is what happens to a system carrying record debt when an energy shock of historic magnitude, a 60+% oil price increase, a 20% global LNG supply disruption, and a central bank policy paralysis crisis all land on it simultaneously. The answer, as we are going to trace through every component of the system, is not a single catastrophic collapse. It is a cascade, a domino sequence, each falling piece triggering the next, each crisis amplifying rather than absorbing the one before it. Welcome to the Domino Collapse Analysis. Section 1. The Foundation: Why the Global System Was Fragile Before the First Missile Was Ever Fired. To understand how a war becomes a global systemic crisis, You have to start not with the war but with the system that the war lands on. Because the same war, landing on a financially healthy, low-debt, high-resilience global economy, produces a contained shock that the system absorbs and recovers from. Landing on a financially stressed, high-debt, low-resilience system, it produces a cascade. The global economy of 2026 is the second kind of system. Let me give you the specific data. According to the OECD Global Debt Report 2026, published this week and cited by Reuters, Bloomberg, and financial publications globally, total government and corporate borrowing from bond markets hit $27 trillion in 2025 and is projected to rise to $29 trillion in 2026. That $29 trillion is 17% higher than the 2024 level and double the amount of 10 years ago. Sovereign bond issuance in OECD countries alone is projected to reach a record $18 trillion in 2026, up from $12 trillion in 2022. Outstanding OECD sovereign debt has risen from $55 trillion in 2024 to $61 trillion in 2025. At 85% of OECD GDP in 2026, it is approaching levels that the IMF's own analysis, published in its Global Financial Stability Report and available on its website, identifies as a zone of increasing vulnerability to shocks. Here is the specific number that makes the current situation uniquely precarious. According to the Empower Financial Analysis, citing OECD data directly, 42% of all global sovereign debt is set to mature by 2027. This means governments worldwide are going to need to refinance a massive share of their existing debt in the next 1 to 2 years. Refinancing means issuing new bonds at current interest rates to repay old bonds that were issued at much lower rates. And current interest rates are significantly higher than the rates at which much of this debt was originally issued during the decade of near-zero interest rates from 2010 to 2022. The United States specifically enters this conflict with debt-to-GDP of approximately 125%, according to IMF calculations, the highest level in American history outside of World War II. Interest payments on the national debt already consume approximately $1.2 trillion annually, or 17% of total federal spending, according to the Department of Treasury's own fiscal data. And the Federal Reserve's policy trap, unable to cut rates because of conflict-driven inflation, unable to raise rates because of already stressed debt loads, means this interest burden cannot be quickly reduced. According to the World Bank's June 2025 Global Economic Prospects Report, which provides the most comprehensive available assessment of global financial vulnerability, the global economy was already navigating significant headwinds before this conflict began. The bank noted risks including trade policy uncertainty, persistent inflation, high debt levels, and slowing growth in major economies. Its June 2025 baseline forecast for 2026 was already below previous projections. And that was the baseline before a war that the IEA has called the largest energy supply disruption in the history of the global oil market. This is the foundation: $109 trillion in global bond market debt, 93% of world GDP, 42% of sovereign debt maturing by 2027. $1.2 trillion annually in American debt service costs alone, a Federal Reserve paralyzed between inflation and recession, central banks globally in the same trap, and now, on top of all of it, an energy shock of historic magnitude. Section 2. The first domino, energy disruption and why it hits harder on a leveraged system. The first domino was always going to be energy. The IEA's March 2026 oil market report, published at EIA.org and cited across Bloomberg, Fortune, and CNBC, stated explicitly that this conflict is creating the largest supply disruption in the history of the global oil market. Oil prices have risen approximately 45 to 60% from pre-conflict levels of approximately $70 per barrel to the current $112 to $116 range. And according to Goldman Sachs's formal research note published Friday and reported by CNN, higher prices could last through 2027. But here is what is different about this energy shock compared to every previous oil shock of the modern era. Every previous oil shock landed on a global economy with significantly lower debt levels, significantly more fiscal space, and significantly more monetary policy flexibility. The 1973 Arab oil embargo landed on an American economy with debt-to-GDP of approximately 35%. The Federal Reserve had room to raise rates aggressively, which it eventually did under Paul Volcker, because the government's debt burden was not yet large enough to make interest rate increases fiscally catastrophic. The 2008 oil price spike, which briefly reached $147 per barrel according to historical EIA data, landed on an economy where American debt-to-GDP was approximately 65%, and where the Federal Reserve had room to cut rates aggressively in response to the financial crisis that followed. Today, American debt-to-GDP is 125% according to IMF calculations. The Federal Reserve is already paying out $1.2 trillion in annual debt service. A rate increase to fight energy-driven inflation would immediately increase that debt service burden, which is already the third largest item in the federal budget after Social Security and Medicare. And a rate cut to support a slowing economy would allow energy-driven inflation to accelerate, eroding the real value of the very government bonds that 4% to 2% of the global sovereign debt market is refinancing by 2027. The leverage in the system amplifies the energy shock's impact in a specific and quantifiable way. According to research from the Federal Reserve Bank of Dallas, cited in the Christian Science Monitor's conflict cost analysis, each percentage point increase in debt-to-GDP ratio raises long-term government bond yields by approximately 3 basis points, or 0.03%. On the current 125% American debt-to-GDP, that means the interest rate sensitivity of the American government's fiscal position is significantly higher than it was in any previous oil shock era. The war does not just impose energy costs. It interacts with the existing debt load to create a compounding fiscal pressure that limits the government's policy response options. Section 3. The second domino, transportation costs and the inflation transmission that is already in the pipeline. The energy disruption has already set the second domino in motion. It is just that most people do not see it yet because it has not yet fully appeared in official price statistics. But it is in the pipeline. It is coming. And when it arrives in consumer price data in April and May, it will change the Federal Reserve's policy calculus again. Here is the specific transmission mechanism with the timing. When oil rises 50 to 60%, the cost of moving every physical good anywhere in the world rises proportionally to oil's share of transportation costs. For trucking, which moves approximately 70% of American freight by value according to the American Trucking Association, fuel typically represents 25 to 35% of total operating cost. A 50% oil price increase therefore raises trucking operating costs by approximately 12 to 17%. For maritime shipping, which carries approximately 90% of international trade by volume according to the International Maritime Organization's World Maritime Review, fuel represents approximately 50 to 60% of total voyage costs. A 50% oil price increase raises shipping costs by approximately 25 to 30%, on top of the war risk insurance premium increases, and the rerouting cost increases from the Cape of Good Hope detours documented in earlier episodes of this series. These transportation cost increases flow into the wholesale prices of every physical good that moves, which is virtually every physical good sold anywhere, with a lag of approximately 6 to 12 weeks from the initial oil price spike. The oil price spike began on February 28th. 6 to 12 weeks from February 28th is mid-April to late May. The April and May Consumer Price Index releases will begin showing the full force of this transportation cost transmission, directly in official U.S. government data. And here is where the debt load makes the transportation cost inflation uniquely dangerous for the current moment. Boston College economics professor Brian Bethune, cited in CNN Business's economic coverage, stated directly that businesses are already absorbing significant tariff costs from earlier policy decisions and have little wiggle room to also absorb higher transportation costs. That little wiggle room he is describing is the compressed margin environment that exists because of the debt levels, the interest costs, and the prior inflationary pressures that businesses have already been managing. The transportation cost increase is landing on a corporate earnings structure that has limited capacity to absorb it. When businesses cannot absorb cost increases, they raise prices. When they raise prices, inflation rises. When inflation rises, the Federal Reserve cannot cut rates. When the Federal Reserve cannot cut rates, the refinancing of 4 to 2% of global sovereign debt that matures by 2027 happens at higher rates than previously expected. And higher refinancing rates increase the fiscal stress on governments worldwide. The chain is running. The second domino is falling. Section 4. The third domino, food prices and the 6 to 18-month agricultural crisis that is already set in motion. Of all the domino effects in this conflict's cascade, the food price transmission is the one that will arrive latest, affect the most people globally, and generate the most severe political and humanitarian consequences. And it is almost entirely absent from current financial media coverage, because it is too slow-moving to generate daily clicks, but will be more important than most of the developments that are generating daily coverage. The mechanism was documented in detail in Part 15 of this series, and has been reinforced by the WTO's Global Trade Outlook and Statistics report published on March 19. To summarize the key finding from that report, a prolonged blockade of the Strait of Hormuz chokes approximately one-third of fertilizer urea imports globally, according to the WTO's own analysis, cited in Reuters and Anadolu agency coverage of the report. Urea is the primary nitrogen fertilizer used in global agriculture. According to the International Fertilizer Association, nitrogen fertilizers are responsible for approximately half of global agricultural output. The countries most vulnerable to Hormuz-dependent urea supply disruption identified in the WTO report include India, Thailand, and Brazil, three of the world's largest agricultural producers. Here is why the debt context makes the food price crisis more severe than it would be in a lower debt environment. The governments most capable of buffering their populations from food price shocks are the ones with fiscal space, with the ability to subsidize food prices, to expand food assistance programs, to absorb import cost increases in state budgets rather than passing them fully to households. The governments with the least fiscal space, the most indebted developing world governments, have the least capacity to provide that buffering. They will pass through the food price increases most directly to their populations. According to the World Bank's Global Economic Prospects June 2025 report, which provides the baseline context for the current situation, developing economy sovereign debt has already reached its highest level since 2007 at 30% of GDP across emerging market and developing economies. That elevated debt load means the fiscal space for food price buffering is severely constrained across exactly the countries where food represents 40 to 60% of household budgets. The compound effect is this: the Hormuz disruption has choked fertilizer supply. Fertilizer prices have risen approximately 35% since the conflict began, according to Time magazine's analysis. Spring planting in the Northern Hemisphere is currently underway or approaching in the most important agricultural regions. Farmers facing dramatically higher fertilizer costs will either pay the higher prices, apply less fertilizer, or some combination of both. Lower fertilizer application produces lower crop yields by a disproportionate amount. According to agricultural science research, a 20% reduction in nitrogen fertilizer application produces a 30 to 40% yield reduction in nitrogen-responsive crops including corn, wheat, and rice. Lower yields with the same global food demand produces higher food commodity prices 6 to 12 months after the planting season shortfall. The 6 to 12-month timeline means that the food price consequences of current fertilizer disruption will appear most clearly in consumer prices in the September to December 2026 window. The families who are today paying more for gasoline will, by autumn, also be paying significantly more for bread, pasta, cooking oil, and every processed food product that uses agricultural commodity inputs. For the global system, the food price cascade landing on top of the energy and transportation price cascades in a high-debt environment is precisely the combination that the IMF's Global Financial Stability Report, in its October 2025 edition, available on the IMF's website, identified as one of the key risk scenarios for systemic financial stress. The report stated explicitly, valuation models indicate that risk asset prices are well above fundamentals, increasing the probability of disorderly corrections when adverse shocks occur. It noted that vulnerabilities reinforce each other, keeping global financial stability risks elevated. It was published in October 2025, before the Iran war. Today, those vulnerabilities are being stressed by exactly the kind of adverse shock the report was warning about. Section 5. The fourth domino, emerging market currency collapse and the dollar debt spiral. We documented the Indian rupee's collapse to a record low of 93 per dollar in Part 16, sourced from Reuters. That specific development is not just India's problem. It is the leading edge of a broader emerging market financial stress pattern that the debt context makes uniquely dangerous in 2026. The mechanism runs through a sequence that is well documented in academic financial economics. A major geopolitical shock triggers capital flight from risky assets towards safe havens. The United States dollar strengthens as global investors buy dollar-denominated safe assets. Dollar strengthening means every country that borrowed in dollars, and there are dozens of significant ones, sees its debt burden increase in local currency terms. The country needs more local currency to buy the dollars to service its dollar debt. If it does not have the foreign exchange reserves to supply those dollars, it faces a currency crisis. Currency crises typically involve sharp devaluations, which increase import prices, which increase inflation in the affected country, which forces the local central bank to raise rates, which slows economic growth and further impairs the government's ability to service its debt. This is not a theoretical sequence. It is the mechanism behind every major emerging market financial crisis of the past 30 years. The 1994 Mexican peso crisis, the 1997 Asian financial crisis, the 1998 Russian ruble crisis, the 2002 Argentine debt crisis. Each was different in its specific triggers. All shared the common mechanism of dollar strengthening combined with dollar-denominated debt, creating unsustainable debt service dynamics in countries without adequate foreign exchange reserves. The countries currently most exposed to this mechanism, according to the IMF's vulnerability exercise for emerging markets, which it updates annually and which informs the Global Financial Stability Report, include those with the combination of high current account deficits, high dollar debt burdens, limited foreign exchange reserves, and significant oil import dependence. The oil import dependence is the specific new element that the Iran war adds to the existing vulnerability picture. According to the OECD Global Debt Report 2026, emerging market and developing economy sovereign borrowing from debt markets hit $4 trillion in 2025, bringing the total emerging market debt stock to $14 trillion. The highest level since 2007. That elevated debt level, combined with the dollar strengthening and the oil price spike, is the specific combination that preceding crises have demonstrated creates cascading defaults. The rupee at 93 per dollar is the visible signal. But behind the rupee are currencies of dozens of other oil-importing developing economies facing the same combination of pressures. Turkey, Egypt, Pakistan, Bangladesh, Kenya, Ghana, Sri Lanka, and a list that extends into dozens more. Not all of them will face currency crises, but the ones that do, the ones that reach the point where their dollar debt service requires more foreign exchange than they can supply, will create financial market disturbances that ripple outward through the global banking system in ways that are difficult to predict precisely but easy to characterize generally. Section 6. The fifth domino, the corporate debt wall and the refinancing cliff of 2027. The OECD Global Debt Report 2026 contains a specific corporate debt data point that is almost entirely absent from current financial media coverage of this conflict. But that represents one of the most significant structural vulnerabilities in the entire global financial system. According to the OECD report, corporate borrowing from bond markets and syndicated loan markets hit its highest level ever in real terms in 2025, at $13.7 trillion, surpassing the previous peak of $13.5 trillion in 2021. Outstanding corporate debt reached $59.5 trillion at year-end 2025, of which $36.4 trillion were bonds and $23.1 trillion were syndicated loans. $59.5 trillion of outstanding corporate debt. In a market environment where the cost of capital is elevated, where the Federal Reserve is paralyzed between inflation and recession, and where energy costs have just risen 50 to 60% across the industrial base that generated the revenues corporate debt issuers use to model their debt service capacity. The corporate debt vulnerability runs through a specific and documentable transmission mechanism. Companies borrowed aggressively during the decade of near-zero interest rates from 2010 to 2022. They borrowed to fund acquisitions, to buy back their own stock, to expand operations, and in the technology sector to fund growth that was premised on free money being available indefinitely. Many of those loans are reaching maturity. Refinancing at today's higher interest rates is proving costly, as the World Debt Clock analysis published in January 2026 explicitly noted. Now add the energy cost shock. The companies most exposed are the energy-intensive manufacturers, the logistics and transportation operators, the consumer goods producers, and the retail operations that were already managing thin margins after years of inflation. Their revenue assumptions, which underwrote the debt service models in their original borrowing, were built on a commodity cost environment that no longer exists. At $112 to $116 oil, the cost structures of these companies have changed materially from the assumptions embedded in their existing debt covenants and credit ratings. Corporate credit ratings agencies, Moody's, S&P Global, Fitch, are in the process of reviewing the credit ratings of companies most exposed to the current energy cost environment. Downgrade cycles in corporate credit ratings typically lead bond investors to reduce their holdings of affected bonds, raising borrowing costs for the downgraded companies, which reduces their ability to service and refinance their debt, which can trigger further downgrades, which creates the self-reinforcing spiral that credit market practitioners call a credit crunch. According to the IMF Global Financial Stability Report, the price-sensitive investors who have become a growing share of the bond market investor base, hedge funds, leveraged funds, algorithmic trading vehicles, are specifically more likely than traditional long-term institutional investors to sell bonds quickly when credit conditions deteriorate. The OECD's language in this week's Global Debt Report is precise on this point. The growing role of more price-sensitive and leveraged investors may also make debt markets more vulnerable to shocks. Their future resilience is therefore not guaranteed. The corporate debt vulnerability is not a current crisis. It is a building pressure. But the building pressure has a specific and observable trigger: the wave of debt refinancing as existing bonds mature over 2026 and 2027 at interest rates significantly higher than the rates at which the original debt was issued. According to the OECD data, 4 to 2% of all global sovereign debt matures by 2027, and the same general pattern applies to the corporate debt market. The refinancing pressure is not evenly distributed over time. It is front-loaded into the 2026 to 2027 window. In an energy shock, high-inflation, policy-constrained environment, the refinancing of this debt will be more costly and in some cases more difficult than it would have been in any other environment. Section 7. The banking system stress signal, what the bond market tells you about what banks are holding. Let me add a dimension to the domino analysis that connects the sovereign debt, the corporate debt, and the banking system through a mechanism that the IMF has been warning about for 2 years, but that has not yet materialized visibly. Banks hold large quantities of government bonds as part of their required capital buffers under the international capital standards known as Basel Roman III. Government bonds are treated as essentially risk-free assets for capital adequacy purposes. The bank gets credit for holding them as if they were perfectly safe. This made complete sense when interest rates were near zero and government bond prices were high. It creates a specific problem when interest rates rise and government bond prices fall. When a bank holds a government bond at its original purchase price, say, a 10-year Treasury bond purchased in 2021 at a yield of 1.5%, and interest rates rise to 4 or 5%, the market value of that bond falls substantially. The bank has not sold the bond, so it has not technically realized the loss. But the loss exists in an economic sense. And if the bank ever needs to sell the bond, to meet sudden deposit withdrawals, for example, it realizes the loss. This is exactly what happened to Silicon Valley Bank in 2023. SVB had loaded its balance sheet with long-duration government bonds during the zero-rate era. When rates rose sharply, the market value of those bonds fell substantially. When depositors began withdrawing funds, triggered by concerns about the bank's financial health, SVB had to sell its bonds at a loss to meet withdrawals, which confirmed the concerns, which triggered more withdrawals, which produced the bank's failure in a matter of days. Silicon Valley Bank was not the only institution with this profile. It was the one that became the visible failure. According to analysis published by Hoover Institution economists and widely cited in academic and policy circles, approximately 186 American banks had balance sheet vulnerabilities similar in structure to SVB's at the time of its failure in early 2023. The same general pattern, banks holding long-duration assets funded by short-duration deposits in a rising rate environment, exists in varying degrees across the banking system globally. The Iran war's contribution to this banking system vulnerability is specific and traceable. By creating an inflation shock that prevents the Federal Reserve from cutting rates and potentially increases the risk that rates stay elevated for longer than previously expected, the conflict extends the window during which banks' unrealized losses on long-duration bond holdings remain large. And by creating economic uncertainty that could trigger depositor anxiety and potential deposit outflows in vulnerable institutions, it increases the risk that the unrealized losses become realized losses in a sudden and destabilizing way. The OECD Global Debt reports specific language about the growing role of price-sensitive investors applies to the banking system dimension as well. Traditional buy-and-hold institutional investors in government bonds, pension funds, insurance companies, central banks, absorb bond price volatility without forced selling. Price-sensitive and leveraged investors, including the hedge funds and algorithmic traders that have become a larger share of the bond market, do not. If they face redemption pressure, margin calls, or algorithmic stop-loss triggers, they sell. That selling increases yields. Higher yields reduce bond prices further. Banks holding those bonds see their unrealized losses grow, and the cycle can accelerate. This is not a prediction that the global banking system is about to collapse. The OECD's summary characterization of current conditions as surface-level calm is accurate. The resilience is real, but the structural vulnerabilities are also real, documented, and quantified. And they exist in an environment where the stress tests were designed around pre-conflict energy and interest rate assumptions that no longer hold. Section 8. Why this crisis is structurally different from Iraq 2003 and Afghanistan 2001. The content for this episode correctly identified that this crisis feels different from past wars. Let me give you the specific analytical basis for that observation, because the difference is not emotional. It is quantitative and structural. When the United States launched the Iraq War in March 2003, the American economy's debt-to-GDP ratio was approximately 60%, according to historical Federal Reserve Bank of St. Louis data. When it launched the Afghanistan campaign in October 2001, debt-to-GDP was approximately 55%. Today it is 125%, according to IMF calculations. The difference between 60% and 125% is not just a doubling in the debt level. It is a fundamental change in the fiscal system's capacity to absorb additional spending. When debt is 60% of GDP, the government has substantial room to issue new debt to fund military operations without creating significant crowding out effects in credit markets or significant increases in debt service costs as a percentage of revenue. When debt is 125% of GDP, every additional dollar of military spending represents a marginal increase in a debt load that is already consuming 17% of federal revenue in interest payments. The global debt picture is equally important for understanding the 2026 vulnerability relative to 2003. When the Iraq War began, the global bond market stood at approximately $62 trillion, according to historical OECD data. Today it stands at $109 trillion, according to this week's OECD report, 76% larger in nominal terms and substantially larger as a share of global GDP. The inflation environment at the start of the Iraq War was also fundamentally different. American CPI inflation in March 2003 was approximately 2.4%, above target but manageable, and in a clearly downward trend. The Federal Reserve had room to cut rates if the military conflict created economic stress, because inflation was not a constraining factor. Today, American CPI was 2.4% before the conflict, and is projected by EY Parthenon chief economist Gregory Dacko to rise to potentially 3% or higher from the energy shock. In an environment where the Fed was already struggling to get inflation down to its 2% target. The specific numerical comparison makes the structural difference precise and stark. 2003. American debt-to-GDP 60%, global bond market $62 trillion, inflation 2.4% and falling, Federal Reserve rate cutting capacity unlimited. 2026. American debt-to-GDP 125%, global bond market $109 trillion, inflation 2.4% before conflict and rising sharply from the energy shock, Federal Reserve paralyzed between inflation and recession. Same type of war, different economic substrate, dramatically different vulnerability profile. Section 9. The Global Trade Cascade. When the WTO cuts its forecast in half, every investor should be paying attention. The World Trade Organization's Global Trade Outlook and Statistics Report, published March 19 and sourced through Reuters and the WTO's own press release, made the most consequential quantitative forecast revision of this conflict from any international institution so far. The WTO cut its global merchandise trade growth forecast for 2026 from 4.6% to 1.9%. That is a reduction of 2.7 percentage points in global trade growth in a single forecast cycle, the largest single-cycle reduction in trade growth forecasting that the WTO has made since the COVID-19 pandemic year of 2020. The significance of that number for the domino analysis runs through a specific and well-documented channel. Global trade is not just a measure of economic activity. It is the primary mechanism through which economic growth is distributed across countries. Countries that participate in global trade capture the efficiency gains from comparative advantage, the technology transfers from working with international partners, and the scale economies from access to global markets. When global trade growth falls from 4.6% to 1.9%, the aggregate GDP growth that would have been distributed through trade activity is effectively lost, not transferred to another country, but destroyed. The WTO's warning scenario, where sustained high energy prices produce global merchandise trade growth falling further to 1.4%, removes approximately $400 billion of global economic activity from the 2026 baseline compared to the pre-conflict forecast. $400 billion of global economic activity that does not happen, does not generate corporate revenues, does not produce employment, does not generate tax revenues, and does not help governments service the record debt loads that the OECD's Global Debt Report documents. For investors, the WTO forecast revision is the most comprehensive available quantification of the real economy impact of this conflict's trade disruption. It incorporates the Hormuz shipping crisis, the Red Sea disruption, the Cape of Good Hope rerouting, the elevated shipping insurance costs, and the general chilling of international commerce that occurs when major shipping routes are contested military zones. It is the institutional translation of everything this series has documented about individual shipping choke points into a single economy-wide number. The sectoral implications of 2.7 percentage points of lost trade growth are specific and concentrated. The companies that depend most heavily on international trade, global manufacturers, electronics assemblers, automotive producers, agricultural exporters, face the most direct revenue impact. The countries whose economies are most trade-dependent, Singapore at approximately 170% of GDP in trade, South Korea at approximately 80%, Germany at approximately 85%, face the most severe macroeconomic impact. For the debt domino analysis, the trade growth collapse matters through its fiscal dimension. Government tax revenues are partly a function of economic activity. When economic activity falls below trend by the magnitude of the WTO's forecast revision, corporate tax revenues fall, income tax revenues fall, consumption tax revenues fall. Falling revenues in the context of rising debt service costs from the higher refinancing rates creates the specific fiscal deterioration that triggers sovereign credit concerns and sovereign bond yield increases, which raises borrowing costs for both governments and corporations, which increases the refinancing stress on the 4 to 2% of global debt maturing by 2027. Section 10. The control versus collapse dynamic, why governments are buying time but not solving the problem. Let me now give you the most honest assessment available of what governments and central banks are doing in response to this crisis. Because the gap between what they are doing and what would be required to genuinely resolve the underlying problems is the most important analytical fact for investors to understand. Governments are deploying every available tool. The IEA coordinated 400 million barrel strategic petroleum reserve release, the largest in IEA history, confirmed by CNBC. The Trump administration's lifting of sanctions on 140 million barrels of Iranian oil, confirmed by CNN. The Jones Act waiver and 60-day shipping waiver, documented in earlier episodes. Georgia's gas tax suspension. European Union emergency energy measures, including an emergency summit to address the price spike, documented by Reuters. And a range of national fiscal measures, including fuel price subsidies, energy bill relief payments, and emergency food assistance programs across multiple countries. These tools are real. They have real market effects. The oil price moderation from $119 to the current $112 to $116 range is partly the result of these coordinated interventions. The IEA's demand guidance, work from home, drive slower, avoid air travel, has reduced energy consumption at the margin. The sanctions relief on Iranian oil has added some supply to the market. But every one of these tools is a symptom treatment, not a cause treatment. The cause of the current crisis is physical. The Strait of Hormuz is not functioning normally as a commercial shipping corridor, and the Gulf energy infrastructure has been physically damaged in multiple facilities. Until the physical situation is resolved, through military degradation of Iran's interdiction capability, through diplomatic settlement, or through some combination, the supply disruption persists. And until the supply disruption is resolved, the energy price elevation persists. And until the energy price elevation is resolved, the inflation pressure persists. And until the inflation pressure is resolved, the central bank policy trap persists. And until the policy trap is resolved, the refinancing stress on $109 trillion of global bond market debt persists. Governments are, to use the specific language of the IEA's own Director General Fatih Birol, buying time. The Strategic Petroleum Reserve releases are stopgaps by Birol's own characterization, confirmed at his emergency press conference and reported by Reuters. The sanctions relief on Iranian oil is a bridging measure that expires April 19th. The Jones Act waiver expires in 60 days. The gas tax suspensions in individual states provide temporary relief that ends when the waiver period concludes. The fundamental constraint is that no government policy tool, however large, however coordinated, however creatively deployed, can substitute for the 21 million barrels per day of oil and gas that normally transits the Strait of Hormuz, and that is currently not moving at normal commercial volumes. The physics of energy supply are not negotiable with any fiscal or monetary instrument. According to the OECD Global Debt Report's specific assessment, published this week, the cost of long-term borrowing has risen, and the resulting shift in issuance towards shorter maturities increases refinancing risks. The growing role of more price-sensitive investors may also make debt markets more vulnerable to shocks. Their future resilience is therefore not guaranteed. Not guaranteed. From the OECD, the institution that manages the policy coordination of the world's 38 most advanced economies, saying the resilience of the $109 trillion global bond market is not guaranteed. In the week of the largest energy supply disruption in the history of the global oil market, that is the precise position of the global financial system right now. Resilient on the surface, structurally vulnerable underneath, being managed by governments with every available tool, and facing an underlying cause, the physical energy supply disruption, that none of those tools can address directly. Section 11. What smart people are actually doing, the behavioral intelligence of this market environment. Reuters published an analysis under the headline that has defined the behavioral prescription for this entire conflict. Don't panic, don't capitulate. Let me build that prescription into the most specific and most actionable guidance available for every listener. The don't panic half of the prescription is the most important for the current moment. The OECD's characterization of current conditions as surface-level calm is accurate. The resilience is real. The global bond market has not broken. The banking system has not seized. Consumer spending has declined but has not collapsed. The equity market has fallen but has not crashed. The stopgap measures are working as stopgaps. And the backchannel diplomatic architecture for eventual conflict resolution is real and active, as documented in Part 19 of this series. In this environment, panic selling, moving aggressively to cash, liquidating equity positions, abandoning the investment framework that careful analysis supports, is the response that converts temporary paper losses into permanent realized losses and removes the investor from participation in the relief rally that will follow the conflict's eventual resolution. The don't capitulate half is equally important, treating the current situation as temporary noise that will resolve quickly, remaining passively positioned in the most vulnerable sectors, making no adjustments to reflect the changed economic environment, ignoring the IEA's historic supply disruption warning and the OECD's resilient Senate guaranteed language, is the response that leaves capital exposed to the compounding domino effects that the analysis in this episode documents. The specific portfolio actions that the current structural analysis supports can be stated directly. The first action is to verify that your portfolio does not have concentrated exposure to the specific sectors and countries most vulnerable to the domino cascade. Heavy exposure to European industrial companies with high natural gas input costs, specifically German manufacturers in energy-intensive sectors. Heavy exposure to airlines at current oil price levels. Heavy exposure to highly leveraged companies with significant debt maturities in 2026 and 2027, in sectors facing revenue headwinds from the energy shock. Heavy exposure to emerging market currencies and bonds in countries with the high oil import, high dollar debt vulnerability combination. The second action is to verify that your defensive positions, energy, defense, gold, short-duration government bonds, are sized appropriately for the duration of the disruption that Goldman Sachs projects through 2027, and the IEA warns could last 6 months. The third action is to maintain the liquidity reserve for the resolution deployment that Part 19 identified as the biggest single market move still ahead. The $109 trillion global bond market, the 4% to 2% of sovereign debt maturing by 2027, the Federal Reserve's rate cut expectations that were priced before the conflict. All of these will begin moving positively and quickly when the conflict's resolution becomes credible. The investors with available capital at that moment will be able to capture the most powerful market moves. The investors who spent their capital on defensive instruments that did not require it will miss those moves. The fourth action is to maintain daily monitoring of the 5 endgame signals identified in Part 19. Oil price stabilization, media tone shift toward negotiation language, intermediary nation diplomatic activity, military tempo reduction, and political language change from both sides. These signals will arrive before the formal announcement. The investors who are watching for them will act before the announcement. That timing advantage is measured in hours to days, but translates into significant return differences on the deployment of reserved capital. Closing. The system has not broken, but it is being tested like never before. The global financial system is not breaking. Let me be precise about that because precision matters more than drama in analytical work. The OECD Global Debt Report's characterization of surface-level calm is accurate. The bond market is functioning. Banks are lending. Trade is continuing at reduced volumes. Governments are maintaining debt service. The system is absorbing the shock. But absorbing is not the same as resolving. And the structural conditions documented in this episode: $109 trillion in global bond market debt at 93% of world GDP, 4% to 2% of sovereign debt maturing by 2027, corporate debt at its highest real terms level ever, the Federal Reserve policy trap between inflation and recession. The WTO's 59% cut in global trade growth forecasts, the IEA's largest-ever supply disruption warning, and Goldman Sachs's 2027 price duration assessment are the specific conditions in which a sustained adverse shock does not stay contained. The domino sequence documented in this episode, from energy disruption to transportation costs to food prices to emerging market currency stress to corporate refinancing pressure to potential banking system stress, is not speculation. It is the documented transmission mechanism of every major oil shock in modern history, operating on a global debt substrate that is more vulnerable than in any previous comparable episode. The lesson of every previous episode is consistent. The system absorbs the shock. It is damaged. It does not break completely. The damage takes years to fully repair. And the investors who understood the structural vulnerability in advance, who positioned defensively before the damage was visible in official statistics, who maintained the liquidity to capture the recovery when resolution eventually arrived, generated the best outcomes. That is the complete analytical picture. The domino sequence is visible, quantified, and historically grounded. The policy response is real but insufficient to resolve the underlying cause. The resilience is genuine but not guaranteed. And the opportunity, for those who see the structure clearly and position accordingly, is extraordinary. This has been Profit Pulse. Stay informed, stay analytical, stay positioned. We will see you in the next episode.